Welcome to the fourth quarter market outlook. I'm CLS's Chief Investment Officer, Rusty Vanneman. Despite a weak ending, this was still a strong quarter for the financial markets. Trade rhetoric generated volatility in market prices and investor sentiment, but overall markets were higher. In this quarterly video, I'll go into more detail on how markets performed. I will also sit down with members of the CLS portfolio management team to discuss the 3 stock market truths. We'll also review the principles behind how CLS builds portfolios, including risk budgeting and the CLS investment themes. It was another good quarter for globally diversified portfolios. Returns last quarter were led again by the U.S. stock market, as the total U.S. market, as defined by the Russell 3000, did gain over 7% for the quarter and is now up nearly 11% for the year. Returns were led by large cap stocks, as defined by the S&P 500, as they were up nearly 8% for the quarter. Smaller companies, as defined by the Russell 2000, gained less than 4%. The international stock markets did lag, as they returned less than 1% last quarter. Developed international equity was up over 1%, while emerging market equity was down over 1%. Within fixed income, despite the fact that interest rates did rise, the U.S. bond market in the aggregate did have a slight positive return. Cash returned nearly 0.5%. Real assets, meanwhile, real estate did gain over 1%, but commodities were down over 2%. For the last year, returns are very strong in the U.S. stock market, with returns up nearly 18% for the U.S. stock market. International equities are lagging with a return of only 2%. As for diversifying asset classes, the U.S. bond market is down slightly over 1% over the last year. This is quite exceptional, as the U.S. bond market is usually higher 85% of the time on a trailing 12-month basis. Among other diversifying asset classes, such as real assets, they are up approximately 3% over the last year. Something else that is notable is looking at the 3, 5, and 10-year returns for the U.S. stock market. Keep in mind that the long-term average return for the stock market, depending on the time frame you look at, is approximately 8 to 10% per year. These returns over the last 3, 5, and 10 years are quite strong. As we'll talk about later in the commentary, the 10-year return of 12% should rise notably in the quarter or two ahead as the strong losses from the bear market 10 years ago scroll off. There are 2 other items to notice on the 10-year returns. First of all, international equities have posted positive returns, though of course they have lagged. Another item to note is that looking at the 5 and 10-year returns for the U.S. bond market between 2 to 4% is actually a good frame of reference for what we will expect returns will look like over the next 5 to 10 years. Lastly, real assets, commodities. They are posting losses over the last 5-10 years. This is also quite exceptional, and we would expect over the next 5 to 10 years it is even possible that these returns could completely flip around and be positive. Now let's bring in a few members of our portfolio management team to talk more about what's going on in the markets and what we can expect in the months ahead. Well, in the quarterly market outlook this month, we did talk about the 3 truths, and you guys actually wrote the piece. Giovanni Zelaya, Case Eichenberger, client portfolio manager, CLS. And so the first truth, Gio, was talking about short-term performance. Talk about that truth a little bit.
Sure. What investors are investing in the stock market because they don't want to leave their money in a savings account, a checking account. So they want to take on a little bit more risk and get compensated for that risk for higher returns. And what we see is that there's volatility in the markets. If you invest in stocks, bonds, inherently they're more risky than just leaving it in the savings account. And so returns will be volatile. In the long run, there is a higher probability of seeing a positive return within bonds. Within 5 years, 100% probability. Bonds returning a positive return. With stocks, is about 80% probability of seeing a positive return. So the longer one is invested, the higher probability that they'll see a positive return. If you want your money within 3 years, 5 years, the stock market might not be a good place to park your money. just because of the fluctuation in returns.
Yeah, I think that's a good point. So really people invest really not to beat the benchmark or the market, but really to beat the bank. And to invest long term, the price you got to pay is that short-term volatility. So actually getting into the volatility though, I mean, that is the second truth. How do we deal with the volatility and the cyclicality of the markets?
Yeah, definitely markets ebb and flow. Not all markets are correlated together. You know, different sectors are correlated differently. International markets are definitely less correlated to U.S. markets, so they have different times where they outperform and different times where they underperform. So that's why we diversify, because we don't know exactly what the future is going to hold, and you don't want to put, you know, again, all your eggs in one basket and just bet on that one market. It's going to be there for the future, because so many different things drive these markets, and we never know exactly what the future will hold. So we diversify. Talking internationally, it's usually, you know, on any given year, a 50-50 chance one will outperform the other. I was just reading earlier this week, you know, we talk a lot about emerging markets and, you know, maybe how they're not working this year, but going back to when the index started in 1988 through August of this year, emerging markets have outperformed the S&P 500 by a little bit. And obviously with a lot more volatility, but I think we just kind of get this perception that they don't deliver hardly any returns sometimes. But over longer terms, you know, it definitely pays to be invested, and it pays to stay diversified for sure.
The markets definitely have a cyclical nature. It's, you know, when you think about it, in most professions that you reward the winners and you cut the losers. But it's interesting in investing, since there are cycles, it's really the opposite. A lot of times you're buying the losers and selling the winners. Well, there is one thing that tends to work over time, particularly for long-term investors, and that's the third truth, and that's valuations.
Save the best for last. The best predictor of long-term performance from academic studies to historical data is valuations. And what does that mean? In our context, we're talking about relative valuations. And so the higher the valuation metric, the lower expected returns an investor should expect from that investment. And what we see is that the U.S. markets are very expensive. They have high valuations, so investors should expect lower returns from this asset class. And so where should we be looking towards? We should be looking towards areas of the market that have lower valuation, more attractive valuations, which would provide higher risk-adjusted returns in the long term. And international markets is an area of the markets that we really like, emerging markets as well. They have low valuations, very attractive, good deals right now compared to an expensive U.S. market. We're also looking at value stocks. Value stocks have been beaten down for several years, but they're very attractively priced versus their growth counterparts. And so we really like those areas, and that's why we're positioned for the future. We're not investing in the past. We're not chasing performance here. We want to position the portfolios in a way that will see the highest returns moving forward.
And I mean, again, the U.S. market over the last 10 years is looking at returns of 20% per year plus, which is amazing. And looking at valuations now, investors should not expect that. And again, as you said, if they're looking to enhance returns over the U.S., we should definitely be looking at international markets. Well, thanks, guys. The three truths are great.
Definitely.
All right.
Thanks for having us.
It was another strong quarter for U.S. markets. Despite a weak ending, domestic markets were still up all around. International markets had a setback, but we still believe the best plan for long-term success is to stay globally diversified, balanced, and invested. If you'd like to know more, go to the website, clsinvest.com, and check out the PDF version of the commentary. It goes into a lot more detail. And lastly, congratulations are due to the CLS Portfolio Management team for winning the ETF Strategist of the Year Award from wealthmanagement.com. That'll do it for this quarter. Thank you for tuning in, and thank you for your time and trust in CLS Investments.